Now, a couple things. Number one, I did want to talk about two targeting, and there's several candidates that I think really fits this discussion. When we do our scouting reports, and today is Delta Tuesday, Matt, which means we're going to talk about a directional component in charting or management or some other form or fashion. And targeting is a big part of any trading plan. You know, it's a critical part of any trading plan. And when we do our scouting report planning meeting, we always come up with two targets for a reason. First thing I want you to do is kind of explain why are there two targets in the first place, and then we'll dive into some examples.
Well, first of all, the first target is always what I would consider a conservative target, right? Where like on a retracement, for example, and let me just pull up my software here for a second. I like to use this software because it allows me to draw a little easier. So like, for example, if I got a retracement like this, right? And it's coming into my nice little support channel there, and I get my upward movement in price right there, right? That's called confirmation. So if I'm looking at a bullish retracement, for example, and I have it come down into that 38 to 50% Fibonacci retracement level, that's kind of the zone I really, really like on retracements. Your first target is always going to be this first area of resistance, right? That's the historical level that we see. We know it's been there in the recent history. We want to target that first area of resistance. The second target is going to be up above the channel, typically speaking, on a retracement, because remember, the pattern in this goes higher high, higher low, higher high, higher low. So the pattern is actually establishing higher highs. So the next target you want to target is typically that next higher high. Now there's a lot of ways to determine what that next higher high is. Fibonacci extensions is one of them. Significant whole numbers is another one. The one that we like to use is more potential average yield. So when you're dealing with the bullish retracement, that's kind of what you're looking at, is your first target being the previous area of resistance, and then your secondary target usually being something like a Fibonacci extension level or potential average yield, which are two very similar. Now, in terms of the bearish retracement T, you have that same type of situation. You have it lower low, lower high. And so on a bearish retracement, your first target is typically going to be the first level of support. Your secondary target is going to be underneath that first level of support. So if it breaks underneath that level, you now have this continuation going down. And again, Fibonacci extensions, potential average yield, those are two really, really helpful ways in terms of identifying where that secondary target is. So that's on what we call a retracement. Now on a breakout, it is a little different. And so like, for example, T, this would be like a continuation pattern that we like to call a cup and handle. Now on the cup and handle, your trigger is right above the resistance level right there. So once it triggers above that level, and then you have a stop loss typically underneath the breakout channel, somewhere around that, somewhere underneath the breakout channel, your first target is going to be your extended target, and then you have a slowing momentum target typically for your second target. So depending on the technical pattern that you're looking at, your targets are going to be a little different. Retracements are a little easier to target than breakouts, simply because you've seen that first area. So in terms of those targets though, you always put two targets, because the first target is a conservative target, your secondary target is your continuation target if the pattern continues. And you make decisions at these levels, right? That's what you have to make, is you have to make a decision. And so let's take a bullish retracement, for example, right? Let's say we have a nice little bullish retracement, good little stock, comes down into our support level, hits our support, upward movement in price. We got a stop loss here. We're targeting there, and then we're targeting there, for example, all right? So as the stock goes up into our first area of resistance right there, you got to understand that the last time it hit that level, it came back down. And a lot of times we see a little bit of weakness at this level, a little bit of consolidation, nothing, you know, big, but just a little bit of consolidation at that resistance level. And so you have a decision to make. And the decision is this: are you going to lock in profit? Do you want to close the position, right? That's option number one. Option number two, do you want to trail up that stop loss? That would be option number two. And then option number three would be to do what's called scaling out of the position. And scaling out of the position is basically, let's say I have, 6 contracts on an option trade. I'm at my first target. I lock in profit on 3 contracts. I trail up the stop loss on the remaining 3 contracts, giving it a little bit of room to run into that secondary target. The only thing you can do that's bad in that capacity, though, T, is to do nothing. Is to literally do nothing. At a minimum, you got to adjust this stop loss up. At a minimum, you got to adjust that stop loss up. So you got to make that decision, though. And usually at that first target, unless I see something concerning in the overall market, in its sector, like slowing momentum in its sector or the market or whatnot, or a big downward movement in price at that point, I'm either going to just adjust the stop loss or scale out. I'm not going to lock in. And then as it therefore goes into that next area, at that point, I'm just locking in profit.
Sure. And from a philosophy standpoint, it completely makes sense. And obviously, there's a reason why traders have to have some gray area in their judgment. And so let's use a couple of case studies to try to highlight these different decision-making factors, right? I went back and I looked at some of our reports in the last few weeks, and I'm loving the reports. I think they've gotten tremendous. They're tremendously valuable. People who are out there who are looking for somebody to kind of go out and bird dog for them, those reports are fantastic.
So, do you think that's going to catch on?
I don't know.
Second question. Do you want that to catch on?
I damn well do. Yeah, absolutely. So I went and looked at the option report, Matt, from January the 5th.
But hold on. Before we pull up your stock, can you give a little context to bird dog? So
listen
that
to the
people are
podcast.
like, wait a second. Okay, just listen to the podcast.
Listen to the podcast. You'll know what bird dogging is. All right. Absolutely.
It's not Tim's Urban Dictionary definition.
Well, first of all, you go into Urban Dictionary, they're going to make anything seem like you shouldn't use it. That's all fake stuff. But I like our definition of bird dogging. We're going to make it catch on, and I love the idea. Matt, I went back to the option report from January 5th, and Coach Tyler was the one who delivered the report. And a lot of the picks, they come from the team exercise and scanning process we do on Friday afternoon. I'm looking at a couple here that I think are great candidates to discuss first and second target. Okay, you ready?
Yeah.
TWLO. TWLO was originally on our report on the 5th, okay, and we called it a bullish play. Our original trigger entry zone was 91.10 or higher. Now, that means a trader has to apply any of their individual rules. They might go to 92 or 91.50 or just say, hey, forget it.
Can I just say what mine is?
Yeah.
Okay. So this would be considered a breakout play, and we've talked about this as a pattern we've seen in the market recently where some of the stocks that didn't get tanked the same way the market did, they kind of held up, but then they formed these reversal patterns. And remember what we said, the trigger was above the high of the right shoulder, and that's what we saw here on Twillo, and that's why the entry was at that point. Stop loss, I believe, had to be under 90.
Mm-hmm. Well,
Okay.
I think our original stop was under 85.4, which was that candle. We had a complex pattern in here. We liked the candidate. And then it was, I think in the video, we were talking about how you would move it up pretty aggressively, but yeah.
Yeah. Once it breaks out and confirms, you want to adjust it slightly under 90, I would say. But, in terms of this rule, Tim, and it's, like I said, every trader is going to be a little different. Some are more aggressive. Some are a little more defensive or conservative in their rules. Typical rules have something to do with the ATR, though, whether you're talking about 10%. So when you see, what was that number, Tim, on the entry? It was 91.10?
91.10.
91.10. So when you see in the scanner report that it says, okay, 91.10, that doesn't mean you put an order at 91.10. That means you have to put an order above 91.10 because that's the high of that pivot. So in terms of that, traders might say, okay, I want to enter in at 10% of the ATR above that level, right? And that's more of an aggressive entry, I would say. So if the ATR is 1, you want to enter 10 cents above 91.10, right? If other traders would be, no, I want to be a little more cautious on breakouts. And, a cautious rule or a conservative rule on a breakout would be, all right, 50% of the ATR above the level. So 50% above the level would be 91.50, right? So it's up to the trader to determine where to put that order. It's not my job to tell people where to, what to trade and where to trade it. It's your job as a trader to say, okay, I need to apply my rule in my system to that breakout channel. So that's why that 9110 and use the ATR. The ATR is a gauge to determine how aggressive or conservative you want to place that order. The target, Tim, I believe the target was, I mean,
First target was 100.
I know the first target because every time it goes above 90, it goes to 100. So the first target is at 100, which was the first area of resistance over here. Secondary target, I can't remember what it was.
110, 110, which is, I believe, a Fibonacci extension.
It was a Fibonacci extension. But in terms of this first target, we're obviously at this first target, right? And you have a question. What do? Do you lock in profit? Do you scale out? Do you do nothing? Do you trail up a stop loss? Let's throw it out to the crew. If my stop loss originally at 84 adjusted up to 89, and let's say we currently have it at 89 right there. Option one, lock in profit. And let's say we have 4 contracts, T. Lock in profit. Option number 2, scale out. Take 2 on Twillo and leave 2 to move up.
Option
number 3, adjust stop loss.
Option 4, turn it into a bull call. I know
option
that's
4, advanced traders, option 4. Okay, first target, you're right. So first target, option 4, roll it into a bull call.
You know, and while those answers come in, people think about it. Here's the fun thing about trading, and you should be very patient with your profits, right? It's a lot easier to handle it when you're gaining. You should be very quick to get rid of losers, and you should be patient with your profit. The mindset would tell you to do something that allows you to continue to make money if you catch the bigger run. But
scaling, let me answer a question very quickly, Tim. Scaling out, Adrian, means that if you have like 100 shares, you sell 50 shares at your first target and you keep the remaining 50 shares. So you're basically splitting you're basically hedging yourself is what you're doing. And again, there's no wrong answer here. The only wrong answer is to do nothing, right? So I see a lot of option two. Me personally, I would say based on the totality of the market, based on this Twillo, right? Hitting its first target, you have momentum coming into it, you're not overextended yet, I wouldn't be locking in profit. No, when I say lock in profit, Michael, I mean you're closing your 4 contracts, right? So that's what I mean. So yes, scaling out is similar to that because we're locking in profit on half of the contracts. So based on what I'm seeing here though, I do see a little bit of slowing momentum at $100. It has had a hard time breaking that level over the course of the last 4 or 5 days, T. You have strength coming into in the last 2 days, and the market could certainly appreciate, especially in this sector. So I would say either 2 or 4 in my opinion.
Yeah.
At a minimum, I think you got to lock in some profit. I think you got to, I do. If you don't know how to roll it into a spread, I think scaling out is the best choice here, right?
Sure.
So, but if you do know how to roll it into a spread, this would be a perfect situation of rolling a directional call trade into a bull call spread.
I do want to mention to Adrian here, first of all, Adrian, we love newbies. So always newbie questions are great. In fact, our veteran halftime crew, why don't you welcome the newbies? So let's make everybody feel great. I think sometimes, Matt, when you're brand new at something, you jump into an environment and maybe you're not as adept at the lingo as the intermediate or advanced people. It can feel intimidating, but we love new traders.
Listen,
that's
we're educators first and foremost, right? So we've been teaching newbie traders how to invest and trade and technical analysis and options and everything for 13 years now, right? Okay, as a newbie, you are in the right spot. As a newbie, you're going to be overwhelmed. Okay, it's par for the course. You're going to be overwhelmed. But the only way you don't get overwhelmed is if you come here every day and you do your job as a trader, and that's what we do here, is we look at, top-down approach to the market on a daily basis. We look at different indexes, sectors, and whatnot. And I get it that the language for new traders can be very, very, very difficult, but I promise it comes fast if you dedicate yourself to it. So believe me, when we're doing this show, Tim, we're not speaking to beginners. We're speaking to our community that has beginners and very, very advanced traders in it, right? So some of that, when we're talking to just trader talk and we go into our trader talk, yes, that's going to be confusing and overwhelming, but just keep with it. And you're seeing some of our amazing team just come in here. And this is why I love this team, guys. It's like Marie coming in here saying, hey, we're all newbies, just keep listening. You know, Andy, who's now been a part of our community for only a few weeks now, Tim, you know, I believe it's 3 weeks, Andy, and he's coming in and just stay with it, stay with it, stay with it. So if you're new, guys, you found the right spot. I promise you that. You have found the right community. Just stay with it.
You've made the right match, which is a good transition into our next company, Match.com.
You swiped right. You swiped right.
MTCH is the next one I want to look at. I don't know. Come on, dude. I'm having fun here. Match.com was on our candidate list in that same report,
That
Matt.
was such a bad joke.
I get it. Dad jokes. Oh,
I like it, though.
It was on our candidate list, and the first target was 47. Second target is 50 here. It had a nice breakout, Matt. We had a trigger above 44. It did do that, start to run. Now you're at 46.59. You're almost, oh my gosh, I mean, just a few pennies from hitting that target here on the top of the candle here today. How would you?
You're in the zone.
Yeah.
Tim, a target is not a specific number. It's a zone. You're in the zone. So you have a decision to make.
Yeah.
So based on everything we just talked about, right? Option 1 was lock in profit.
Mm-hmm.
Option 2, scale out. Option 3, was basically adjust stop.
Mm-hmm.
And option 4 was roll it into a spread. So what do you think?
You know, I would go for option 1 probably. I would take it off. Yeah, you're at the top end of a channel here as well, and also at the old pivot point on that gap fill. If I want to let something run, I'm probably in other candidates. I like the upside. You could debate that one though, because if you can get through 47, it's got clear sailing to 50, right?
Technically, and again, there is no wrong answer here. There is no wrong answer. This is an answer up to the individual to make, right? So when Tim says I'd lock in, I see the reason. I see it. He's locking in because it filled the gap. I know my brother.
Yeah.
I know what he's doing. He's locking in because he's like, I don't think it's going to get above the gap level. And if it gets above the gap level, I can get back in. I get it. I understand. There's nothing wrong with that. I love the strength coming into it though.
Yeah.
I do. I love that strength coming into it. You just broke out of a high base. You have big green candles. Big green candles are typically momentum candles. Volume is a little concerning. Volume is a little concerning, but I would adjust stop loss there. I'd scale out or adjust stop loss. That's kind of where I'm at on it.
Such an important part of trading, guys, is knowing to get rid of losers quickly and how you handle winners. It's all about trading plans. I was having a discussion the other day with a veteran trader of mine and that I have mentored and taught over the years, Matt. And, you know, we were talking about something really simple. And at first he kind of got down about it because like, well, why do I have to have a, discussion about the most simple thing I should have figured out years ago, right? And I'm like, no, you don't understand. I mean, that's the complex part of any trading. But by the way, any field, the more advanced you get, the more nuanced even the simplest things can become. How you handle target 1, target 2 is critical, for traders. And that's whether you trade options or stock or futures or Forex.
On high dollar stocks, I've found scaling out and rolling into bull call spreads is advantageous.
Yeah.
That's what I've found. When you're talking about that first target, I don't think it's wise to just lock in all the time on the first target. I mean, if you'll remember, and I've said this in the past, but if you'll remember, there's 3 outcomes to every trade, Tim. There should not be 4. There are 3 outcomes to every trade. Outcome number 1 is you take a small loss. That's what your stop loss is there for, right? Now, option number 2 is you take a small win. That's what that first target, adjusting the stop loss, that's what that means. You're at your first target, you're adjusting a stop loss, it comes back down, you get stopped out for a small win. Or you scale out and lock in profit. Gino loves to aggressively scale out when he starts making money. So that's that small win. And your third one, and they're needed in the market, is those big wins. And if you constantly just aggressively lock in profit at that first target, you're never having those big wins, right?
Mm-hmm.
You're never having that one that, you know, bounces on 47 and before you know it, it's up to 54, right?
Mm-hmm.
Because with all the good intentions aside, your good intentions to get back in at 47, above 47, doesn't happen a lot, Tim. Because
No.
either one, you're not in front of the market, or two, you're late to the party and you found it 2 days late, right? Take Netflix, for example. It went parabolic. Well, if you just constantly lock in, you miss out on that. I love what Coach Noah says. You need to keep it open, and I got to move my video so I can see what Coach Noah said, so I can get it on the record here. You need to keep an open-ended risk graph for the gains. I agree with that.
I love the conversation. Obviously, we got a lot to focus on here. Ending the halftime report. I want to go rapid fire.